Ladies and gentlemen, we've done it one more time. Another beautiful trade. Now, unfortunately, I ended up making some sizing mistakes, which means I only made a fraction of what I should have made. So right here, you can see the actual execution. Don't mind the 13,000 in profit. That is from a long position. This is the one I'm talking about, okay? $1,741 in profit. And just to make sure you know it's real, we're going to come up here where it says more. And then it opens our entire position history. You can see that exact same trade right there at $1,741 in profit. If we come up here, you can see that it says USDTM. If I switch demo, well, then again, there's absolutely nothing recorded. If we go into USDTM, which is the live account, we have those exact same orders. So again, let's break down exactly what happened here so that you can learn from my experience. So ladies and gentlemen, this is the exact trade that I'm talking about, okay? And I used a very, very specific strategy here that I think a lot of you are going to benefit from. So again, what we're going to do here is pretty much break down exactly what happened. And you're going to get my entire process. And of course, as you guys know, if you've watched the videos before, the first thing I do, right? This was on Thursday this week. So the first thing I do, at any given day is check the economic calendar. Now, on this specific day, we had unemployment claims, okay? Now, in case you don't know who I am, what I do, and how I trade, I always, and I mean literally always, trade when there is high impact news, okay? I don't want to trade on a day where there's no high impact news. There's one specific reason for this, okay? I know a lot of you have been fooled into believing that, you should trade on days with no economic data, but to me, that's nonsense. Why? Because you're going to trade a flat market, right? And in order for you to profit, in my opinion, properly, well, then there just needs to be volatility. And you're going to find that on high impact days, okay? So this was a day with unemployment claims. Now, when I'm trading on an intraday basis, right, I don't care about the outcome of the news because they're not going to have a massive effect on my trading, intraday wise. And so that's not really what I'm paying attention to. I'm essentially just paying attention to the color of the folder, right? And I'm using Forex Factory. It's what I've used for years on end. It's what I'll continue to use. And again, this week was rather volatile. So yeah, I was more than happy. I think on Friday, we actually had NFP. We had, non-farm employment change. And so when we have a day like this on a Friday, what I'll typically do, obviously I traded this Thursday, right? But what I'll typically do if the conditions are just not there, which you can see here, right? Obviously, we had a massive volatility on Thursday. But oftentimes when we have a Friday that is this packed, so oftentimes that's, NFP Fridays or, for example, FOMC Wednesdays, well, then I won't trade the day prior to that. So that's Tuesday for FOMC, that's Thursday for NFP, right? And there's one reason for that. You see, when we have this many high impact news on a given day, well, then the day before tends to be very, very slow price action. Why? Well, because all the big players, right, the whales, the institutions, all the big players, they're waiting to deploy their money until the final massive news have been released on Friday, right? But luckily, on Thursday, we still had unemployment claims, which again spiked the market with some sort of volatility. So let's break down exactly what happened. And it all starts here on a higher time frame, okay? Always, I never just chart on one time frame. I always do top-down analysis, and I'm actually lying. It's a 4-hour time frame that I want to look at. So let's quickly cover the recent Bitcoin price action, right? Because we have been in the same consolidation since early February. Right, so we've just been stuck inside of this consolidation for God knows how long. That was until recently, right? As the war in Iran broke out, people sort of seemed to move towards Bitcoin as a hedge against the war because Bitcoin was the only asset that they could buy, right? And so they would rather hold an asset like Bitcoin than, for example, the dollar or God knows what, right? And they obviously couldn't buy gold because, again, the market was closed. And so they all pivoted towards Bitcoin, and we saw massive displacement above the actual consolidation here, right? Now, what this screamed to me on an intraday basis was the fact that we had swept so much liquidity, right? So what I mean by that is simple. If we take a look at the market here, God knows how many people have been trading this consolidation, right? Millions of people. Some people may have traded this trend line here, right? Some people may have traded the breakout that happened right here. And so we have so many stop orders, at highs like this, and this, right? We have millions of dollars in stop orders at these very highs. And so when the market decides to finally break out here, well, then again, it's going to accumulate all of those orders that we have here, right? It's going to liquidate all of these traders. And what typically happens after that is the fact that we aren't, going to see a pullback. But if we zoom in even closer, what you might notice is the low that I've annotated, right? It's not just any low. It's in fact a low that's part of an imbalance. So in case you don't know, a fair value gap is very simple, and it's a 3 candlestick pattern. So right here we have 3 candlesticks, right? If we take the bottom candlestick's top wick and the top candlestick's bottom wick, right? You see that there is a massive inefficiency here. The space in between the 2 wicks, that is our fair value gap, market inefficiency, imbalance, whatever you want to call it, right? And it's quite simple. It has 2 functions, right? The market uses it in one of 2 ways. Either it uses it to come down and retest it, much like a traditional support level, right? And then, that fair value gap supports price higher. Or what it also can do is trumble through the entire imbalance all the way down here and fill in that entire inefficiency, before, of course, moving higher. And I guess there is also the final option where we just completely trade through it and continue down lower, right? That's always a possibility, and it actually happened right here. Okay, but that's not important, because what I use fair value gaps for is rarely to support price higher or lower. What I use it for is to determine where price is going to go next, right? So allow me to explain here. I've explained this in multiple videos, and I'm going to do it one more time for the people that don't already know. The market typically does one of 2 things. It either fills imbalances or it seeks liquidity. Now, liquidity is what we just established here, right? It's stop orders within the market, it's money within the market. Now, most people will naturally pivot towards liquidity, right? They're going to use liquidity as a way to determine where price is going to go next. They're going to look at the highs and lows within a market, and then they're going to determine where price is going to go next based on how much money is at the highs versus the lows, right? Now, I do the opposite. I nearly always pivot towards option number 1, which again is to fill inefficiencies. Okay, and you might wonder, why do you do that? Well, because I want to be on the opposite side of the majority, right? And so if the majority, goes with option number 2, which again is seeking liquidity, well, then again, I want to do the opposite of them, and I'm going to go for imbalances, right? And I've also been trading for damn near a decade at this point, and I can tell you with confidence that if you get an imbalance within the market, chances are it's going to get hit, right? For example, right here. So we have a larger fair value gap that you're looking at here, right? Obviously, the market came down, retested that, and then again moved higher, just as I explained before, right? Then we have another one here, right? Another fair value gap here that got hit, and I mean, this just goes on forever. We have one here. We even have a small one right here, and again, all of these got hit. Right? And so chances are, when we have a leg like this, where we actually have 3 imbalances, right? We have one here, we have one here, and we have one here. Well, then chances are they are going to get hit 9 times out of 10, just like literally every other fair value gap within this leg, or actually within this entire consolidation, right? And so when we swept the highs, I figured, okay, well, millions of people have been liquidated here. Chances are the market is going to, cool off for a little bit after sweeping all these highs here. And it's going to cool off down towards these imbalances here before continuing higher. And this is actually another model. I know, a lot of information here. I can't believe I'm giving this away for free. And by the way, all the trade breakdowns I share with you, I share with my team in real time, okay? So for example, right here, we took a long. That was beautiful, and I called it out in real time. So again, if you want to become part of our beautiful community here, well then do me a favor, check out the link down below, because we would love to have you. And the value you get for the price you pay is ridiculous. Anyway, the model I'm talking about here is quite simple. Okay, price goes from external range liquidity, and then it goes to internal range liquidity. And this might seem, confusing at first, but this is exactly what it does. And in order for you to understand what that means, you have to understand the difference between external and internal range liquidity. So for example, right, we have a massive consolidation here. You find the lowest point of that consolidation, which in this case is the low that we put right below 60,000 over here. So this is the lowest point of the consolidation, and this is the highest point of the consolidation. In other words, what we're seeing up here is the external high, right? And what we're seeing down below is the opposite. So this down here is the external low, right? Any high or low in between those two, right? So anything that goes on inside the consolidation or in between the external high And the external low is what we call internal range liquidity. So this is an internal high. This is an internal high. This is an internal high. This is an internal low, and so on, right? That is the difference between external range liquidity and internal range liquidity. Now, what most people don't know actually, or don't understand, is the fact that imbalances are also liquidity. Right? So this imbalance, because it's inside of this consolidation, we consider that internal range liquidity. And there's a rule. Typically, when a market goes above an external high or below an external low, well, then what it's going to do is rebalance towards an external low, or in this case, an external fair value gap, right? An external imbalance before continuing higher. Right? That's typically what price does. And as you guys can see, that's exactly what happened. Right? The market ran up. Right, it liquidated all the orders at the external high. Now it's making its way down into, internal range liquidity before, again, hopefully making its way higher. And that is simply the nature of the market. And that's exactly what I was looking to capitalize on here. And again, you might say, well, that's not a lot of price action, right? But I'm executing. I think this trade here was executed on a 2-minute time frame, and this is a daily time frame, right? So there's plenty of price action to get a short down towards an internal imbalance, right? Which is exactly what I did. So again, zooming in here on a daily time frame, we have a fair value gap, which now after watching this video, there's a high chance the market is going to rebalance towards that, right? And if I now zoom into a 2-minute time frame, we can see that the market was in fact moving in that direction. And what confirmed it for me was what happened after the market swept the equal lows that you're looking at here. Right, so we have certain liquidity pools that are more significant than others. Right, equal lows or equal highs is one of the most important liquidity pools that you can even think about, right? Because if a market goes up or if a market goes down aggressively, like it did here, obviously this went up very aggressively, that means there's likely millions of people longing this market at this time, right? And if you had to guess, right, if you were longing from this point forward, where would you put your stop order? Well, you would likely put it here or here. Right? There's a high chance that every single person that's long within this leg here have their stop orders at these lows. Why? Because that is trading psychology. That's where they're all taught to place their stop orders. And the market knows this, right? And so it comes down and it liquidates these orders at the equal lows because, again, of what I just explained, right? People that long this short up move, they have their stop orders here. People that long this up move, they have their stop orders here. And they're both still in the market, right? And if we now go all the way over here, you can see that when the market swept this low, it had an initial struggle here with this massive bullish candle, but then it continued the downtrend. And that tells me one thing. Sellers are in control. Buyers are too weak, and we can determine that by looking at the highs. Right? So up here, for example, we have a high that was swept right here, right? And if I were to ask you, where did we see follow through? Below the low or above the high? You would most likely say below the low, right? Not above the high, and you'd be correct. And so when this happens, it tells me that, okay, buyers cannot push price above highs. They're not strong enough, right? But sellers, on the other hand, they can in fact push price below lows because they're strong enough. They're outweighing the buyers, right? And so the market structure was quite clear to me because this had, quite literally happened throughout this entire downtrend on a 2-minute time frame. We have another high here, right? That got swept, nothing happened, right? No follow through to the upside. And if we now compare that to the low that, right here, you can see that we in fact saw massive follow through. We can say the same thing up here where this entire downtrend on an intraday time frame actually started. The high, no follow through. The low here, massive follow through. Right? And so that is pretty much how I evaluate the market structure 9 times out of 10. And so I was confident that this was a bearish market based on everything that I've just told you here. And so all I had to do was pretty much look for a short down towards the daily imbalance that you're looking at here. And I got the opportunity here, right? I was waiting for a pullback to happen. And the pullback that you're looking at here was the first pullback that, I saw when I came into the market. The first pullback after this low was swept, right? And that's, exactly what I was waiting for. So what I did was really simple. I saw, again, massive displacement down lower after the pullback, indicating that, okay, sellers are still in control. Buyers tried to take over here, but failed, right? And what you notice here is we got follow through below the low here, right? And again, much like everywhere else in this leg, we got no follow through above the highs, right? And this confirmed it to me. This confirmed that, sellers were still in control. And so what I was looking to do here was capitalize on the existing trend, and I did so using a Fibonacci extension tool setting. So if you're on TradingView and you come up here to the left, right, we have a tool called the Fibonacci retracement tool. I drew it from the top of that bull pullback all the way down to the low that we had created right here after selling off completely. And then I'm blessed with these two zones, right? And I call these zones my golden zone, okay? And it's pretty much the 0.71% and the 0.79%. You have the settings right here in case you don't have them already. And the idea here is that when you get a pullback within a market, right? So this is a pullback and this is a pullback. Well, then that pullback is likely going to end within one of these two zones. And that was exactly what I was looking to capitalize on, right? And you might wonder, well, why didn't you take your profit all the way down here? The reason for that is quite simple. Right here, these lows, I'm getting a 2.4R trade. And there's a pattern that has been repeated. I've also mentioned this, in previous videos throughout these last couple of weeks. In fact, a pattern that has been repeated throughout this entire consolidation that you're looking at here. And that is the market coming incredibly close to highs or lows and then completely reversing, right? And so this was the daily imbalance. And so to ensure that I didn't get left behind, I took my profit at this low instead of at this imbalance, right? And if we play out price, you can actually see that exact same pattern repeated itself, right? We got super close to that daily imbalance and then we started trading higher, right? And of course, later down the line, we did in fact end up hitting the daily imbalance just like I had imagined. But imagine I had to sit through all of this. In fact, I would have, most definitely gotten stopped out at break even here, right? If I had, stuck to the idea that I had to take my full profit at the imbalance, right? Because look at this. I mean, we were just stuck in that for so long. And again, eventually we did, as you guys can see, end up hitting the imbalance. So the overall idea wasn't wrong. It's just the fact that the market these last couple of weeks here have been incredibly hard to profit within. And I found, I combated that through basically taking my profit at internal versus external, right? And so that was pretty much the entire trade. And just to show you, I'm sure we can find other examples throughout this leg here. So if we now draw it from this high down to this low, you can see that the pullback that happened here also ended within those two same zones. Unfortunately, I didn't get to capitalize there. Let's have a look here. I don't think this one quite made it. Yeah, it did. So this pullback also ended in these two zones right there, right? And I mean, it goes on and on and on. If you take the swing high right here, so we take it from that high down to this low, well, then you can see that this pullback also ended within these two zones, right? And so if you get the trend right within this Fibonacci extension tool setting is, in my opinion, one of the best tools that you could possibly use for trend continuation plays, right? The problem here is most traders think that the Fibonacci extension tool is only for reversals, whether that's using the 71, 79%, or whether that's, using the optimal trade entry, which is right here, doesn't really matter, right? People always try and assume that this is only for reversals, but I just showed you that this is one of the strongest trend continuation tools if you know exactly how to use it. Now, luckily for you guys, I have an entire school community that you automatically get access to if you're part of the Telegram, where I literally break down step by step every single system that I have ever used, including the one that I just showed you, right? So I have two primary systems that I've built upon years and years of data, and I've broken down both of them within the course that you're looking at here. So again, the value within this group is just absolutely crazy. So again, if that's of any interest, make sure you check out the link down below. So, ladies and gentlemen, that was pretty much the entire trade. Now, again, unfortunately, I made some sizing mistakes that only allowed me to capitalize on a fraction of what I actually should have made. But again, that is just first world problems. Now, regardless of this being a winner, loser, or break-even trade, as soon as I hit buy or sell, I immediately log it, okay? As the more data I can get, the more happy I am. Why? Because the two systems that has pretty much given me financial freedom are both, created upon mistakes of mine. So I had collected data for about 6 or 7 years total, and those two systems are crafted and tailored to me specifically. That's only possible because I had the discipline to collect data. And so a lot of people find it boring, tedious, repeatable. They don't like it, right? But in reality, it is exactly what separates people that consistently make money from people that do not make money on a consistent basis. So anyway, ladies and gentlemen, thank you so much for watching this video. I hope you enjoyed. Again, I hope to see each and every one of you inside of our Telegram group. And without further ado, I will see you in my next video.